In this video, we'll look at basic consolidation at the date of acquisition. Two scenarios: goodwill on acquisition and then gain from a bargain purchase. First, we will look at goodwill on acquisition. An investor acquires business control with goodwill. On 1st of July 20XO, Michael, an investor, acquired 100% of Samuel's business ownership for $500 million. At the date of acquisition, Samuel's business had share capital $200 million, retained earnings $280 million, and shareholders' equity, therefore, is $480 million. That's represented by machinery, $480 million. Liabilities are zero, therefore the net assets are $480 million. Michael had issued $500 million share capital, which was used to acquire Samuel's business. Required on 1st of July 20XO, that's at the date of acquisition. First, show Michael's group financial statements. Second, show consolidation journal entries. Michael's parent entity, in that Michael issued share capital $500 million, and that was used as an investment in subsidiary, which is that $500 million, to acquire previously Samuel's, now Michael's subsidiary, share capital of $200 million, retained earnings of $280 million. So the investment is more than shareholders' equity by $20 million. Because Michael's parent invested in Samuel's business, now Michael's subsidiary invested in it to gain control over assets and liabilities, we now need to eliminate the investment in the subsidiary and the shareholders' equity so that we can show the assets and liabilities that Michael gained control over subsidiary. So to do that, we need to credit investment in subsidiary $500 million and debit share capital of $200 million and debit retained earnings of $280 million. Because Michael invested more than shareholders' equity, there was an asset, a collection of assets which were not individually identifiable, which was not on the balance sheet. They are the goodwill on acquisition of $20 million. Now, we can combine Michael's parents and Michael's subsidiary business. And when we combine the two, goodwill on acquisition is $20 million and the machinery is $480 million. Together, total assets less liabilities, and the net assets are $500 million, is represented by Michael's share capital of $500 million. The consolidation entries are what was shown on the adjustment columns on the spreadsheet, which we credited investment in subsidiary $500 million, debited share capital in subsidiary $200 million, and debited retained earnings in subsidiary $280 million, and it resulted in goodwill on acquisition $20 million. Second scenario is basic consolidation at the date of acquisition, gain from a bargain purchase. Here we have taken an example. An investor acquires business control with bargain purchase. On 1st of July 20XO, Michael, an investor, acquired 100% of Samuel's business ownership for 500 million. At the date of acquisition, Samuel's business had share capital 200 million, retained earnings 330 million, and is represented by machinery 530 million, less liabilities 0, and net assets are equal to 530 million. Michael had issued 500 million share capital, which was used to acquire Samuel's business. So Michael invested less to acquire shareholders' equity of previously Samuel's business, now Michael's subsidiary. Required to show Michael's group financial statement, and second, to show consolidation entries. Here, Michael's parent issued share capital 500 million, that became the investment in subsidiary 500 million in Michael's parents, and that 500 million was invested to acquire share capital of 200 million and retained earnings of 330 million equals to 530 million, which means the investment was less than the shareholders' equity in the Michael's now subsidiary. Because Michael's parents invested in now Michael's subsidiary to gain control over assets and liabilities of the subsidiary, we need to now eliminate the investment in subsidiary and the share capital and retained earnings of the subsidiary. So we credit investment in subsidiary 500 million and debit share capital 200 million and debit retained earnings 330 million. Because Michael invested less to acquire shareholders' equity, there is a gain from the purchase. That bargain purchase gain is 30 million is shown in the income statement as an immediate gain at the date of acquisition. However, the revenue and cost of sales are 0 because it's at the beginning of the reporting period. So in the income statement, the 30 million credit or the gain appears in the group financial statement. In the consolidation entries, what was shown on the adjustment columns has to be generalized. So credit investment in subsidiary 500 million and credit gain from purchase bargain is 30 million and debit retained earnings in subsidiary 330 million and debit share capital in subsidiary 200 million. That brings us to the end of the video. Thanks for watching.